Greetings, fellow investors. Over my 29 years in this business, my primary investment strategy has been to buy and hold stocks of healthy, growing companies. As my picks' dividends have risen, so have their share prices. The happy result? I've increased my income and wealth at the same time. That formula is still working nearly 7 years into one of the most explosive bull markets in generations. And frankly, most of my best calls, including buying at the bottom in early 2009, have simply been due to keeping my cool while others panicked. I still believe quite strongly that most market movements aren't worth reacting to. Changing market conditions, however, sometimes call for shifting tactics. When I'm camping in polar vortex weather, I want a parka and a sub-zero sleeping bag. And when I'm investing in an aging bull market like this one, I adapt to momentum swings. Yes, there is an inevitable bear market in our future. And the longer this bull market lasts, the more important it is to hold only stocks that will weather the downturn. But there's also a major opportunity from buying momentum that all too many investors overlook, particularly those seeking income. That's banking windfall gains that can represent years of dividend payments. On December 19th, I emailed an alert to Conrad's utility investor readers. My message was to book a gain of 33.2% in Scana Corporation. When I recommended the stock 13 months earlier, I fully intended to hold it for at least 5 years. That's when the South Carolina-based power company plans to have 2 new nuclear power plants up and running and earning large sums of money. But by mid-December, Scana had catapulted to a share price nearly $8 above my entry target for new investors. That difference was equal to nearly 4 years' worth of dividends. Selling the stock enabled readers to bank the full amount in advance and avoid what now appear to be rising risks of cost overruns at the new plants. Scana was just one of 6 positions I took similar profits on in 2014, for an average gain of nearly 50% over an average holding period of just 11 months. In early 2014, Windstream Holdings, a wireline telecommunications company I held in my aggressive portfolio, yielded nearly 10%, as many investors worried about the safety of its dividend. But by late July, management had trapped short sellers in a squeeze by announcing the spinoff of network assets into a real estate investment trust. Ironically, at the time, no one seemed to notice the spinoff was accompanied by a dividend cut, but I alerted CUI readers and exited the position in early August for a gain well north of 50%. Since then, investors' enthusiasm for Windstream and its REIT plans has cooled. In fact, short sellers have actually had the last laugh. The stock has lost 1/3 of its value, more than $4 per share from my exit point. I always enjoy talking to readers, but many people I spoke with in August confessed that it was tough to give up on a stock with such a generous yield, especially when it finally seemed to be breaking out. Fortunately, those that did banked the equivalent of nearly 5 years of dividends in advance, and they avoided a large and still expanding loss in the bargain. Probably the hardest sells of all are high-yielding stocks that have recently lost ground. But more often than not, selling is the best possible thing you can do. 12 of the 16 stocks on my endangered dividends list a year ago have since cut dividends and punished investors with big losses in the process. Take the case of Canadian oil and gas producer West Petroleum. The company has been on my endangered dividends list for most of the past year. The reason? Management's continuing inability to restore profitability, even as it downsized the company with asset sales. Things first came to a head in October 2013 as the company nearly halved its dividend. Many investors assumed the worst was over. Unfortunately, it wasn't. In December 2014, West cut its dividend by another 80%. The loss since the false bottom following the previous cut, a staggering 86%. On the other hand, not every stock investors believe has an endangered dividend is truly at risk. Last year, for example, CUI readers realized a better than 40% return in Enbridge Energy Partners when the owner of pipelines resumed regular dividend increases. Separating the Enbridges from the Penn Wests and Windstreams of the world requires two very important strengths: knowing your coverage universe well and a steady hand. For nearly 3 decades, I've tracked and advised readers on the 212 high-dividend essential services companies in the Conrad's utility investor coverage universe. That's more knowledge and experience than almost any Wall Street analyst, and it's literally decades more than anyone else in the investment newsletter business. I've also been a steady hand through market crises from Black Monday of October 1987 to the 2008-2009 crash. Are we headed for another such debacle? I certainly hope not, but there are unfortunately plenty of potential catalysts for one, starting with the more than halving of oil prices over the past 6 months and its uncertain impact on scores of other markets and industries, including, regretfully, the banks. Probably the biggest risk right now is high valuations, which means expectations are extremely easy to disappoint. Even the Dow Jones Utility Average is in the danger zone now, trading at 21.3 times trailing 12 months normalized earnings at last count. No one rings a bell at a market top, but as we enter 2015, these risks have me on high alert. And I've added 2 key tactics to my long-term buy and hold strategy. First, I'm going to continue taking profits in stocks whenever buying momentum takes them well beyond the realm of reasonable expectations. That's an opportunity to book returns that would otherwise take several years of dividend payments to achieve. And my current targets are in the January issue of Conrad's Utility Investor. Second, the only stocks I'm going to recommend are clear values. Fortunately, even this late in the game, there are still plenty of unloved electric, power, pipeline, energy distribution, communications, and water companies around the world that present compelling values. For example, there were twice as many sell and hold recommendations for Enbridge's buys when I first recommended the partnership to CUI readers in late July 2013. And there were almost 3 times as many bears as bulls on Hawaiian Electric when I entered a position roughly a year later. Despite covering Hawaiian for more than a quarter century in my former publication, Utility Forecaster, I'd never once recommended the stock, and with good reason. The company had never once increased its dividend and was at perpetual risk of a cut. In fact, in my early days as an analyst, I had a rather testy exchange with an executive of the company about its high-cost oil-fired power plants. Changing times call for changed perspectives, however, and the Hawaiian Electric of 2015 is not the company of 1989. Last summer, I saw a company tackling its problems head-on and not getting credit for investors for its efforts. And a few months later, readers were up by more than 40% as NextEra Energy made a generous takeover offer. Every month, Conrad's Utility Investor highlights my 2 best picks, one for aggressive returns and the other for conservative income and wealth building. January's aggressive pick is a pipeline company set to lift its 5.6% dividend by another 10 to 15% in 2015. And thanks to overblown concern about its exposure to falling oil prices, it's selling more than 40% below its September highs. That's a formula for big profits that works in any market. The conservative pick pays a dividend of 5%, which it will increase at least 8% this year. It's the world's largest pure play on hydro and wind power, with expanding sales locked in by long-term contracts to the very strongest customers on 3 continents. You know, a lot of people thought achieving rising income and reliable capital gains would be impossible in 2014. We proved them wrong at Conrad's Utility Investor. Picks like these are how we'll capture strong returns once again in 2015 despite the greater challenges, by playing to our strengths and keeping a steady hand. That's what I promise you at Conrad's Utility Investor. Please click on the green button below to find out more about my unique service. And thanks for tuning in.